3, 2, 1.
All right. Here we are again.
At
the end of another amazing week. I cannot believe the number of things that have happened since the last time we were sitting in this room here doing this podcast.
I think it's going to be that way all year.
Yeah.
Especially till November.
Yeah. Yep. I mean, there's obviously all kinds of things we can talk about, but we just talk about what the market does and keep on moving. It's going to be a pretty interesting podcast. We keep obviously everybody's talking about, the assassination attempt on Trump, and then whether or not Biden's going to stay in the race, right? So those
are like the biggest topics right now, and it changes daily, every version of it, right? I mean, this is probably this has got to be the most chaotic time I can remember outside of war, right? And it was whenever we have gone to war, it's always somewhere else, right?
Yeah.
So it's chaos, but you're like, oh, it's there.
Right.
It's not here.
Right.
This chaos is happening here,
right.
And it's So I mean, and the thing is it's changing daily, and with so much social media, you get so many versions, and you got to filter, and you got to and we're really only looking at it from how it impacts the market, right? At the end of the day, and Jerry and I talked about this late last night. At the end of the day, I think this is probably the best time to be a technical analyst, because as a technical analyst, at the core of that kind of philosophy, way of looking at the market, the price is the only thing that matters, right? That's where you start as a technical analyst. Now, you can get broader in your methodologies and your toolkit and what have you, but if that's your come from, if that's where you start, chaos doesn't matter as much,
right?
Because you're not trying to figure out why everything's happening. You're just responding. And that is probably the most valuable thing you can do right now if you're an investor. Even if you're not a big technical analyst kind of person, you're going to want to be on that side of the fence, because you're not going to be able to. The old rules don't apply anymore.
For a lot of different reasons.
And it's been that way for a while,
yeah.
Right? It's not just right now. It's been heading that direction for a few years. It's at its peak right now. I don't even know if we hit the peak yet.
Who knows? Yeah.
Right? But the point is, price is the only thing that matters. You're responding to what the market does. You can't try to predict it. You can't try to figure out why it happened. It's nice to know why.
Yeah.
But it's going to be too late by the time you figure out why.
Well, as soon as somebody says this is why this happens, there's 5 other people that have other reasons for why it happened.
Absolutely. Yeah.
That's actually why technical analysis is critical, because if you think you know why, or if you think you know why something's going to happen, that's even worse. If you think you know why something's going to happen, and you reallocate based on what you think is going to happen, you might be right.
Yeah,
and
well,
awesome.
You could just put it all on red too.
Exactly, that's what you're doing.
You're gambling, right? Yeah. Just roll the dice. No, we don't want to play that way.
We're going to do a big piece of the S fund over the last several weeks.
Let's get into it.
Yeah.
Man.
So, okay. We're going to take a review of snapshots of the last 4 weeks of newsletters that we did. So if you're a subscriber to the site, this is what we've been talking about in terms of the S fund over the last 4 weeks. We got a pretty good question in the Facebook group that comes up once in a while, so we'll take a look at that. Yield curve and recession. I can't remember if we did this before, but it's a big one. And employment to population ratio, probably one of my favorite indicators right now. Bonus chart is Tesla, and then TSP fund charts. All right. So if you're a subscriber to the site, for the last 4 weeks, this is what we were talking about in terms of the S fund, right? So June 23rd. This is before, yeah. Okay. So while the NASDAQ and the S&P are extremely overbought, the majority of the market is at or close to oversold levels. Okay, so you got the S&P at extreme overbought, and you get the rest of the market, in the S&P, the other 493 companies, but below that is the S fund, which is 4,500 companies. So the new high, new low line has fallen substantially since the peak in 22. Is it possible that the upturn we've seen since October 2023 bottom is signaling the beginning of a monster rally in the companies that have been beaten down for the past 2 years. This could happen even if the Magnificent Seven stocks consolidated or declined. In that scenario, the S fund would potentially blow out the C fund. This possibility is also consistent with Fundstrat's Tom Lee, who's calling for a 50% increase in the price of the small caps, our S fund, by the end of the year. So that's 4 weeks ago, we posted that. And this is the chart we're talking about. We were referencing Sven Hendrick's interview on Thoughtful Money, and this is the link right here. What he's talking about is this is the S&P 500. This is the new high, new low index. So what happens is whenever the new highs outpace the new lows, the line's going up, and the S&P is going up. When the new lows start exceeding the new highs, the line comes down and the S&P goes down. And it's like that all the way along until we get to where we were in the bottom in 2022. That was October 2022. The new highs, new lows list kept going down until the beginning of 24. But the market was going up. So that divergence is something you don't see anywhere else back here. Okay? So what Sven was saying and what we put out 4 weeks ago, if the new high, the new high, new low list had just started to tick up. So if that continued, it gave all kinds of room for the market to keep going. But the new highs, new low list was so low. These are the companies below the Magnificent Seven. The reason that the S&P kept going higher is because of the Magnificent Seven, right? So these way oversold the rest of the market. It was so oversold, it had potential to move much higher, even if the S&P itself went sideways to down. This is basically the S fund going up and the C fund going sideways to down, right? So we're talking about that 4 weeks ago. 3 weeks ago, so the S fund weekly chart shows a clear triangle consolidation pattern forming with higher highs and higher lows. This is the first significant consolidation since that strong rally off the October 23 bottom. The expectation is that the consolidation resolves in the direction of the prior trend, right? That's how it generally works. This means that price should break out of the consolidation to the upside, but price needs to prove it. So barring a breakout of the triangle pattern, it's not really worth the risk. So this is what that was, right? This is the bottom in the S fund in October 23. We get this big rally, and now we're in this triangle consolidation. And it's the first consolidation since we had this big move off the bottom. So we're just waiting for this triangle to tell us which direction price is going to go next. The expectation is it goes higher, right? And then this move is the same length as this move. That's what the textbook would tell you would happen. But it doesn't have to. It can break down from a triangle consolidation pattern, then that would just look like a rollover, right? So you have to let it play out to see. So that was 3 weeks ago. 2 weeks ago, S fund lagged a little bit this week, but still well within the triangle consolidation pattern until price breaks above the downsloping trend line or down below the upsloping trend line. The pattern continues. Eventually, time will run out and the pattern will resolve. So that's what it looked like there. That was the following week. It was down a little bit, but still within that triangle consolidation pattern. And then last week, we're saying, so this is the last Friday, right? So for the subscribers, we did the podcast last Thursday. So if you're a subscriber to the site, we do the newsletter after the close on Friday. So you get all the information that happened for the week. So as long-term active TSP investors, we want to be on the right side of the trend. We're not attempting to time the market. That means the trend needs to change and we reallocate accordingly. A breakout from a consolidation pattern is usually the beginning of a new trend. We will need to see higher highs and higher lows to confirm the trend change, but this week's explosive move breathed new life into the underperforming S fund. So that came out last Sunday, it was the 14th, but we did an alert, if you're a subscriber, on Friday morning. So you would have gotten Friday, if you followed the new model, the new grow model portfolio, you would have moved 50% into S fund as of Friday's close. So this is the weekly newsletter, but we also do alerts when we make a change in the portfolio.
Yeah, and the purpose behind the portfolio, just to kind of give a little insight to that, if you're not familiar with how we do our things, because a lot of people stumble across this and see the podcast that don't always know, like, we have a whole other side to this, basically,
right.
where the bottom line is we're first and foremost try to teach you how to actively manage your account, right? And we don't necessarily push you in any particular direction. We try to just get you doing it, right? Now, we obviously have tools that we use, and so we said, okay, we're going to make a model portfolio, and that's going to give us an opportunity to kind of, it's like the teacher giving you the answer to the equation kind of thing, so you can figure it out. It's not necessarily telling, hey, you should do this, right? So let me give you an example. So we went 50C, 50S. We were 100% C, for obvious reasons, for weeks and weeks and weeks, right? What Jerry just explained was leading up to what we saw could happen in the S fund. You look at that and you go, okay, well, there's no reason to get out of the C fund right now. We're looking at everything, right? If you're watching the newsletter every week, no reason to get out of that, but there's a reason to get into S. So you could look at that several different ways. You could say to yourself, I'm going to wait it out and see what the S does. Okay, so you stay in C. I'm going to put some in S fund, so I'm going to balance that out, and that way I can take advantage of both until I get a reason to leave C. Right. Or you can just go all into S because you feel like, and all those things are based on your circumstances. Do you have enough time to watch the market? Are you educated enough to know how to make a plan A, a plan B? Do you, what's your risk tolerance? Yep. All those things come into play. So that's why when we say, we're not telling you to do this, we're giving you an example, one of many that you could do. And so those are the kind of things that our subscribers get, like on a weekly basis. Is what we do. We match two things up. We match education and analysis. We're actually getting ready to fire off a whole bunch of courses we've been working on pretty much the whole year. That will be a huge education piece that we've been wanting to get out for a long time, and that's going to be exciting. And you guys are going to see that soon. Did you lose track? Okay. That's my rambling.
No, we're good. Okay, so this was the chart that we put out last week. By the end on Friday, we had broken out of that triangle consolidation. The buyers, this is the ADX indicator, the green line is the buyers. So when the green line's going up, it means buyers are coming into the market. The red line is going down, that's sellers. Sellers are leaving the market. We had a big uptick in relative strength indicator. CCI went straight up, and MACD had just barely not crossed positive. Right, it's minus 5.78, but it's moving in the right direction. Okay. So what exactly happened? Like we all know the S fund exploded to the upside. So what exactly happened here? We were talking about sector rotation. So if you don't follow Lance Roberts, realinvestmentadvice.com, he puts out a ton of free information. It's really good. We've been talking about sector rotation for quite a while, and this is a really good chart that kind of captures the whole thing. These are all the sectors within the S&P 500. Okay, so 60 days ago. So he's looking at this from 60 days ago or the last 60 days, not 60 days ago, the last 60 days cumulative and the last 10 days cumulative. Okay. So you got tech, which has been driving everything. So in the last 60 days, tech was up 5.06%. That's taking into account the losses that it's taken in the last 10 days. But it's way up, and that makes sense because tech's been driving the whole market, right? But in the last 10 days, tech is down 3.5%. So at the same time, like real estate had been down 6.3% over the last 60 days, but it's up 5.6% in the last 10 days. So you can see that everything flipped, right? Everything that was really strong for the last 60 days, right, now we got basically what was red is now green, and what was green is now red. That's sector rotation. What it really also means, what's good, is that if all of this was red, then the market's collapsing, right? That's when we have a big problem. But as long as we have sector rotation going on, it's given a chance for tech and communication services, let's say, to pull back. And they should. I mean, they've been going straight up for so long. They need some time to like digest those gains and pull back. But the rest of the market is at least taking up some of the slack. So you don't have everybody fleeing the market. You have people moving money from one sector to another.
Right.
So even though we're looking at it and going, oh, the C fund's down for the week, the S fund's down, whatever, if you don't know what's going on underneath, you don't know if you really have a problem or if it's just sector rotation.
Just cooling off a little bit. That's what everybody has to always remember about the market. The market is not a thing. It is people.
Right.
It's companies, right? Companies, ebb and flow, right? Their revenue does, their staffing, their all the things, right? And especially when they're massive companies. And then you have things happening outside of the company that's influencing the market. So anyway, these are normal things. What Jerry's getting to is really important, is understanding what's going on underneath the surface, right? Particularly, it makes it easier that we only have 500 companies to worry about, right? At least in the C fund, right? Because those sectors are pretty well defined. And if you go to the website that Jerry's using there, I mean, you can just Google it. It's SDPR, I think, SPDR, Spider. Yeah. If you just Google that, they have a website, and you can dive all the way into the sectors and the holdings in each sector, and they've got all this great data, and you can see really quickly, once you get used to it, these rotations happening. And so if you see that, maybe the C fund is cooling off a little, but you also see what Jerry just pointed out, which is just basically a rotation of where the money's going, and that takes a little time. We may still be good, right? Like Jerry said, everything's red and it starts to cool. There's a red flag, right? There's a problem.
There's a time to freak out, and there's a time to say, oh, okay, I see what's happening.
Right. And that would keep you. This goes back to my earlier example of like, I don't really have a reason to get out of C completely. Right. Doesn't mean I'm not. So what do? You take a little off the table from C, put it in the S. Now you've got a balanced portfolio. If both of them are going up, great. If one starts to slack off, okay, I'm not getting killed. Like this is, and again, that's all based on your circumstances and where you're at and your education level and all that stuff. But this is all like really good stuff to understand. Yeah. So, if you got to go back and look at this again or go spend some time, I try once a week to go in there and just kind of take a look and see what's going on with these companies. And, I tend to drill down all the way to the actual companies. And what you'll see sometimes, and this is stuff that, is outside of the scope of the TSP, right? Because we can't invest in a sector in the TSP. Right. But let me tell you something, in your IRA or your brokerage account, you sure as heck can.
You can do it in the mutual fund window. Every one of those sectors has a mutual fund.
Yeah, I'm not as quick to do that just because I still feel like it's clunky. Like I want to be able to get it. You're going to remember you just squeezed it down to about 40 companies in one sector, 30 companies, something like that. And so volatility can be really bad. So doing that in the TSP is a little sketchy for me.
It is.
Again, my risk tolerance. In my IRA, I could wake up in the morning and be like, bam, I like what XLY is doing, right, or XLK, and I'm going to get a little piece of that, right? And so, and I'm watching it, right? And I'm like, okay, I've gotten what I want out of it. I don't see anything to give me a reason that it's going to rotate. The good thing is like that's how you can really shave some extra return, right? But you got to be on the game. You can't. That's not a set it and forget it kind of thing.
No, none of this is set it and forget it.
You don't get. This is all active management, so you don't buy that. And
if you're watching this podcast and thinking that you want your C fund or S fund ride or die or whatever it is. You don't care about any of this.
Yeah, I don't know why you're watching, honestly, other than just to make fun of us.
Yeah, right. And there are plenty of people that do that, and that's fine.
Okay.
Okay, so we had a pretty good question in the group recently. So this is when it was last week, so it's about the S fund. But initially, assuming moving to the S actually causes a loss due to the price of shares. This is something that it's certainly an argument, but I think it's fact. I don't think there's anything to really argue about. The share price is meaningless. There's a lot of people that think
in the TSP.
In the TSP, yeah. So,
not everywhere.
No. Yeah, just stick with TSP for a second.
Yeah.
If you have $1 million in your account and you buy, how do I want to say this? If a stock is $100, and you want to buy $1,000, you have $1,000 to invest, right? Your $1,000 can buy 10 shares of a $100 stock or 1,000 shares of a $1 stock. The price of what you buy, it doesn't matter because you're investing $1,000, right? So if the stock that was $10 or $100 goes up 1%, you made 1%. If the stock that was $1 goes up 1%, you made 1%, but you had 100 times more of that. It still just went up 1%. So the only thing that matters is the percentage move of the TSP fund that you're in. The share price doesn't mean anything. A lot of people think that at the end of the day you win because you have more shares. If the price is going down and you have more shares of an asset that's going down, you're going down with it.
Right. That has to be your metric in the TSP, right? Most people want to find a percentage gain or loss to be their metric. Your metric, listen to this, folks, just stop what you're doing. Your metric is your TSP account balance.
Yep.
If it's going down and there's something you can do about it, you can stop it from going down. That's called going to the G fund. It's called going to cash if you're outside of the TSP. People do it all the time. Active managers do. Warren Buffett just did it, right? Half of his portfolio is in the quote-unquote G fund.
Yep.
Let that soak in, okay? Because this is vitally important. What matters to you, your performance metric is your account balance. If it steadily stays about the same or goes up, you're winning.
Yeah.
Don't worry about the share price, how many shares you own, all of these things. Where I think this really gets confusing for people is because they hear this stuff on CNBC and Bloomberg and whatever. Or they read investing material that's not TSP related or not retirement account related. Because this really applies to a 401k, TSP, or an IRA, right? When we say retirement account, that's what we mean. None of those platforms, right, are really affected by buying and selling like you are in a brokerage account.
Right. You don't have to worry about the tax implications.
You don't have to worry about tax implications. That's why you aren't worried about the share price. And let me explain why that matters in a brokerage account. You will see people that, like, when he said that, like, the thought is, okay, if I sell this now, am I locking in my losses? Am I going to lose money? In a brokerage account, in any account outside of a retirement account, what you're talking about is you don't realize a gain or a loss until you sell or buy. Right? Sell, actually. When you sell something, you either realize a gain, I made a profit, or I realized a loss. And that loss can help you in certain situations and tax implications. None of that has anything to do with the TSP.
Right.
Your account balance is the only metric. So if the C fund is going down and you're 100% C, your account balance is drifting with it, right? Now, if you think based on all the things that's going to come back up, okay, so be it. But if you're risk averse and you don't want your account balance to go down, you can reallocate to G. None of that has anything to do with share price.
Right.
You have to look at this. The only time it ever even closely matters, and it still isn't that big of a deal, is when you take new money, right? The money you're putting in from your paycheck every pay period, every pay period. That is the only time you are ever buying anything.
Right.
That's it. Once you have put your money into the account, you're not buying S fund shares. What you're doing is reallocating. Notice the word they use, allocating. So you're taking this bucket of money and you're moving it over to this bucket. That's all you're doing. You're distributing your account balance. And so if something is making your account balance go down and you get out of it and your account balance stays the same, that's your metric.
Right.
Is that?
And ideally, you move it into something that's going up.
Absolutely, or staying flat, right? I mean, sometimes people have to really remember that some of this is about wealth preservation. Rich people don't worry too much about 20% gains.
Right. Right.
They're trying to preserve what they have.
Yeah, and if you're a retired, government employee,
You want to preserve what you have.
Yeah.
You don't want to lose money, okay? You just don't. Hopefully you can gain a little bit, beat inflation, overcome your withdrawals, like all those things. Yeah. But at the end of the day, what you don't want is two things taking your money.
Right, because you're taking withdrawals.
And the market.
Right.
Because you're in the wrong thing. That is horrible.
And you can't contribute anymore.
Right. So hopefully all of that, I mean, that's two different ways of looking at it. Like what Jerry explained is basically, that's how it works in the TSP. And then, I hear people ask questions like this, and what I hear is them repeating something they heard from some
Bloomberg or whatever.
Right? And I'm like, no, man, this is a retirement account. It doesn't work that way. Yeah. But
hopefully that helps.
What is your metric, folks? Put it in the comments section.
Yep.
Tell us what your metric is. Hopefully you put in there your account balance.
That's the right answer.
That's the right answer.
All right. So a couple things to kind of think about going forward. Yield curve and recession. So the top line, black line, is the 10-year yield minus the 2-year yield. Okay, 10-year Treasury yield minus the 2-year Treasury yield. So what you would expect would happen in a normal market, right? If you're going to lend the government or some company your money for 10 years, you would expect to get a better rate of return than if you were going to lend it to them for 2 years, right? Because there's all kinds of risk. You don't know what's going to happen over that 10 years. Is the company still going to be around? Are you going to be able to get your money back? There's a lot more. You don't know what's going to happen in the world. Interest rates can go up and down. There's a lot more risk when you lend money, whether it's the government or corporate bonds, for 10 years versus 2 years. Okay, so in a normal environment, you get paid more. The rate of the interest rate is higher on a 10-year than it is on a 2-year. So when the line is moving up, it means you're getting more interest on a 10-year than you are on a 2-year. When it's moving down, it's coming back down. When it crosses the zero line, once you get below that zero line, you're getting paid more for a 2-year bond than you are for a 10-year bond. And it's a head scratcher how that can possibly happen, but it's an indication that the economy is not doing well. Okay, and so what happens is it's called an inverted yield curve. So when the 10-year minus the 2-year is below zero, it's called inverted, right? That doesn't necessarily mean it's a problem. It's when it uninverts. So the dotted red lines I got are all these time periods where the inverted yield curve uninverts and moves back in the positive direction. And that always corresponds, it's really hard to see this one in the 1990 recession, but it's always the beginning of a recession. So it's not when the yield curve goes negative, it's when it goes positive again that you have problems. So that was the 1990 recession. In 2000, we had a negative yield curve, and then right when it's turned positive, that's when the market really started rolling over. It was a little bit of a pre-warning here in 2007 because it turned positive before the market really started going over. It was the same thing in COVID, right? We just barely got to zero and turned back up, and that was, right before COVID. Where we are right now, the market's super high, right? This is the S&P 500, super high, and this is the longest period of the yield curve being inverted since, at least going back to 1990. So we've had this really long inverted yield curve since somewhere in 2022, and it looks like, right, you got a 1, 2, it looks like it's breaking to the upside. And when it crosses that zero line, very likely we're in trouble. Okay, we're not there yet, but we're going in that direction. Okay, and it's it happens every time. You know, it doesn't mean we're going to get big, huge declines like this. You could have a pretty mild recession like we did in the early 90s, but the potential is there for a really big market decline. So, it doesn't mean go run to the G fund. It just means pay attention to what's happening with the yield curve, because when it gets positive, hopefully the market only goes sideways, but there's a big potential for it to come down a lot. Okay, so that's the yield curve. The other one that I really like is the employment population ratio. So it measures the civilian labor force. So this is kind of important because if you watch any of this stuff, I think it was last week or the week before when unemployment came out, the jobs numbers, there was like 70,000 government jobs created and I think 130,000 total. So there were more government jobs than civilian jobs created. So these numbers can get really skewed when the government does certain things.
Now, does that just count federal government, or is that all government?
All government.
Yes, that's awesome. I just wanted to note that, right? Because that could get confusing. Like, there were 70,000 federal jobs that came out. No, that's across the board from city, county, state, and federal. Yeah, just any public service job. Yeah.
So it measures the civilian, so it's not government. Civilian labor force currently employed against the total working age population. Okay, so it's a pretty simple metric. People that are available to work versus the working age population. It doesn't move very fast. It's not super volatile, right? But when the line's coming up, once it starts to roll over, you're going into recession. And so, okay, that was the 1990 recession. It rolls over here in July of 2000, and the market's falling. It rolls over here in 2007, right before the top, right? And the market falls. COVID obviously is a one-off because the government, put everybody out of work. So this isn't even worth looking at, to be honest. But where we are right now, after COVID, we came back up. We've been going sideways here for a while, but it certainly looks like we're rolling over. And so if we get down here below this low, right? So you're talking about 59 and change. If we get down here somewhere, it's very likely that it'll basically confirm that this thing's rolling over and the market comes down. And my opinion is the unemployment is the most important thing, because if unemployment gets too bad, then people are not contributing to their 401ks, and all the money that was going to all these companies is not going there anymore, and so earnings get worse, and it's a self-fulfilling prophecy that the market comes down. But we are right on the cusp of it, and I was squinting at this chart trying to find a time where it rolls over and then picks back up and goes in the other direction, and it's just not there. So take it for what it's worth. Okay, Tesla, pretty interesting. So if we just go back here to 2019, this is all like stock splits and everything else. So I don't know that Tesla was $20 back here in 2019. It could be, but I doubt it. I think this is like split adjusted chart. But Tesla's super cheap back here. It does a 1, 2, 3, 4, 5 to a top for a 1. It does an A, B, C for a 2. So if that count is correct, this is a 1, 2, 3, 4, 5. Right? Tesla goes way higher from here. In the short term, we got this really good wedge, right? It's not exactly the same kind of idea, but similar to what we were talking about in the S fund before. And we just broke out, we had a big breakout through that wedge a couple weeks ago. This is a weekly chart. We're coming back to retest that breakout, and then what should happen is it explodes to the upside. So if you're looking at Tesla here, and let's say you bought it right there, if it went back into the trading range, you would sell it. So whatever this amount is your risk, right? But you're looking at this, and if this count is correct, 1, 2, 1, 2, 3, 4, 5, Tesla's going to explode to the upside. Again, it's a weekly chart. There's a lot of volatility from day to day in Tesla, obviously. But this is a really, really strong looking chart because if it goes the other way, your risk is relatively low. All right. I can't, we use these examples, but you can absolutely do it in TSP, and we did it on the S fund. When price tells you, when you get a breakout in the pattern, it's the lowest risk for the highest potential reward. All right. So TSP fund charts.
It's also a great opportunity if you're like if you like the swing trading methodology, right? That's one of the courses that we're going to be putting up, and so some people like to swing trade in their TSP. We'll leave that aside for a second and think about the regular market, right? Outside of that, that is a great kind of chart for doing like a swing trade, meaning you come into it waiting for something like that to happen, and you say to yourself, okay, I'm going to put a target of 10%, right? I'm going to buy this. My risk is really low right now, right? So, go back to the chart. My risk is really low. It popped up above that trend line. I'm going to buy it. I don't know how far it'll go. I don't know what it's going to do. But what I am going to do is watch it. If I hit my 10% mark, great. I'm out, regardless of what it does after that, right? I walk away, take my gains and walk away. Or it starts to roll over, and I need a plan B, right? How much am I willing to take before don't just ride it all the way down. But that is a good kind of swing trade right there, where you would just say to yourself, okay, I'm gonna buy when it does this, right? What Jerry just showed, and then I'm gonna already have a predetermined target. And then at any point, if it doesn't hit that target, this is when I'm out. Right. If you set all those things in motion, this is a relatively easy trade. It's also very low risk, right? Because you've marked out all your stops, right? And you're like, okay. And with all the things considered, that's a pretty darn good low risk situation where you could lock in a nice little gain. Now, the caveat to all that is it's not a swing trade if you buy it and then just hope. Right. That's not how it works.
No, that's an investment. If you think Tesla is going to go up in the long term,
and there's nothing wrong
buy it
with
here, that's fine.
We bang on buy and hold a lot, but that's from a retirement account perspective. There are plenty of things that I buy and hold. Outside of my retirement account that I say because I fundamentally think this company is going to grow over time, right? Or it's undervalued, right? That's a Warren Buffett approach, right? He's a value investor. Yeah. He's looking for something that is way undervalued. I buy it. It actually comes up to its value. So, it was just that's a great investment. Also investing in a company that looks like it's going to grow 3x in the next, year, right? 10x.
Sure.
Right.
Plenty of them do.
Yeah. Those are all different things outside of your retirement account.
Right.
That's just different.
But it's all learning. It's all good.
Yes.
It's all good stuff. All right. TSP fund charts. So, C fund right now, this is a weekly chart of the C fund, 20-week moving average line. Okay. The reason I circled those circles that I did is because of the red candle. So, a bearish engulfing candle is when can I zoom this in? Nope, I can't. When this red candle engulfs the previous candle. So the high of this red rectangle and the low of the red rectangle engulfs the whole prior candle. It's called a bearish engulfing candle because the implication is that the market goes down after that. And so in each of these, going back to the top, at least in 22, you don't always get it, right? This was not a bearish engulfing candle and the market rolled over. But when you do get that bearish engulfing candle, it's not a good sign, okay? And that's what we have, as of Thursday this week. I mean, who knows what's going to happen by the close on Friday, but where we are right now, it does not look good on a weekly basis. it can still, I mean, can you have a bearish engulfing candle, and then the next week, you get a little bit of support and it keeps going higher? Yeah, that can absolutely happen. But it's definitely a big red flag. Okay, S fund. So we had this monster breakout last week, right? And this week, Monday and Tuesday, we got all the way up to the top of that wick. And then Wednesday, Thursday, Friday took it all away. So one of a couple of things is going to happen. We're going to get support right here. And we're going to keep going higher. Definitely a possibility. If it gets back into the trading range, it's a failed breakout. Okay, and failed breakouts happen. I mean, there are no guarantees in this game. The best place to buy into the S fund was last week on the breakout. And obviously we had a huge move at the beginning of this week. And then, I mean, who knows there's all kinds of speculation that the assassination attempt solidifies that Trump's going to be the president, and because he's going to be the president, he's going to do all these tax things, and that's why the S fund broke out. And then this week, so that's why it gapped up in the first couple of days of the week. But then this week, apparently there's a bunch of talk now that Biden actually might not run, and so the market doesn't like uncertainty. And so now that we'll have a new person on the other side, that's why the market's been tanking in the last couple of days. Like that, there may be something to all that. I don't know, and I don't care. All I know is we bought in at a really low risk reward place, and if the breakout fails, you just get out. If it fails and the S fund rolls over and everything rolls over, that's what happens. But to have a reason why you do what you do, and a reason why what your plan B is really how you stay on the right side of the market. iFund, nothing's changed here if you've been following us for a while. We had a triple top at 82 back in 2021, $82. We came up and hit it 4 times earlier in the year. We came up and hit it again last week, and then completely rolled over again this week. So until we get above 82, the iFund, the expectation is that the iFund's going to hit this as resistance, because it's been resistance all the way along for a long time. So if it hits resistance and rolls over, if it gets below this low, it's going down. If it hits resistance and keeps staying above this trend line, if it keeps coming down and bouncing up and down, eventually it's either going to break up or it's going to break down. And so we're just waiting to see what's going to happen with it. Because if you buy into it or sell it now, either way, you're guessing. And then the best hope, I shouldn't say the best hope. In the worst case scenario, the Fed has kept rates too high for too long, and the market crashes. In that scenario, yields drop because the Fed is lowering rates to try to put a floor under falling stock prices. And when yield goes down, the price of bonds goes up. And so our F fund is the price of bonds, and it's right on this head and shoulders bottom formation with this as the neckline. So if the economy is about to break, stocks are going to tank, and the F fund is going to explode to the upside. Now, having said that, if the market doesn't tank, the F fund still goes up because we know the Fed is going to lower rates. Okay, so the least risky place to be right now is the F fund, because they're pretty much telling us that the market's the rates are going down, so the F fund's going to go up. The problem is, for a lot of since 2022, from not the whole time, but for most of the time, and it's happening now, the F fund is going in the same direction as the stock funds. So until that changes, as long as the market's going up, you want to be in the stock funds. If the F fund stays, if somehow yield goes up and stocks fall, which seemingly can't happen, but if it does, then the stocks and the F fund will roll over, and then the G fund is the only option. So you just have to know. There's only 5 funds, so it's not rocket science, right? But there are a lot of possibilities within the 5 funds. So obviously, we talked about what we put out on the S fund for the past 4 weeks. In if you're a subscriber to the newsletter, and we were setting you up for this idea that the S fund could potentially break to the upside, and that is actually what we expected, and that's what happened. Mm-hmm. It could fail, it could roll over and fail.
Yeah, absolutely. But that's what we've been waiting for.
That's how it works. Yeah.
And it happened.
Yeah.
Guys, if you like what you're hearing or seeing, please share it with your friends. If you have any comments or questions, as you saw, we like comments and questions. We end up putting them in the show sometimes because they're great learning material. Put it in the comment section wherever you found the video. If there's not a comment section, you can always email us at support@growmytsp.com. Hope you guys are having a great weekend, and we will see you next week.
Out of here.
Bingo.